Subscribe our channel eFinance Management and click on the bell icon to get update on new videos. Today we are going to explain you equity shares and types of equity shares. Equity share is one of the main sources of finance for any company. Normally, a company is started with equity shares as its first source of capital from the owners or promoters of that company. After a certain level of growth, more capital is required for further growth. The company then finds an investor in the form of friends, relatives, venture capitalists, mutual funds, or any such small group of investors and issue fresh equity shares to these investors. A point comes where the company reaches a very big level and requires huge capital investment for business growth. It then offers its equity share to the general public. This is called initial public offer, IPO. More such issues in future are called follow-on public offer, FPO. They are categorized under long-term sources of finance because, legally they are irredeemable in nature. For an investor, these shares are a certificate of ownership in the company by virtue of which investors are entitled to share the net profits and have a residual claim over the assets of the company in the event of liquidation. Investors have voting rights in the company and their liability to the company is limited to the amount of investment. Equity share is a main source of finance for any company, giving investors rights to vote, share profits and claim on assets. Various types of equity capital are authorized, issued, subscribed, paid up, rights, bonus, sweat equity, etc. There are various types of equity shares classified based on various things. In the financial statements of a company, equity shares are placed on the liability side of the balance sheet. They are classified into various categories which are as follows: authorized share capital, it is the maximum amount of capital which can be issued by a company. It can be increased from time to time. Some fee is required to be paid to legal bodies accompanied with some formalities. Issued share capital, it is that part of authorized capital which is offered to investors. Subscribed share capital, it is that part of issued capital which is accepted and agreed by the investor. Paid up capital, it is the part of subscribed capital, the amount of which is paid by the investor. Normally, all companies accept complete money in one shot and therefore issued, subscribed, and paid capital becomes one and the same. Conceptually, paid up capital is the amount of money which is actually invested in the business. There are other types of equity shares discussed below. Rights share, these are the shares issued to the existing shareholders of a company. Such kind of shares is issued to protect the ownership rights of the investors. Bonus share, these are the type of shares given by the company to its shareholders as a dividend. Sweat equity share, these shares are issued to exceptional employees or directors of the company for their exceptional job in terms of providing know-how or intellectual property rights to the company. Various prices of equity shares are par, or face value, it is the value of a share of which it is accounted in books of accounts. Issue price, it is the price at which the equity share is actually offered to the investor. Normally, the issue price and face value of a share are same in the case of new companies. Share premium and share at discount, when a share is issued at a price higher than face value, the excess amount is called premium. Contrary to it, if the share is issued at a price lower than face value, it is said to be issued at a discount. Book value, it is the ratio of the total of paid up capital and reserves and surplus divided by total number of shares. This is the balance sheet value of shares. Market value, in the case of companies listed on stock exchanges, the market value of the share is the price at which they are sold, currently sold in the market. Thank you. Please subscribe, like, and share our video.